Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing 3 cannabis stocks. The first company we're going to look at is Canopy Growth, then Cronos, then the last is SNDL, also known as Sundial. Let's get started with the model. This is a small cap company, 315 million market cap. They're trading at 60 cents a share, and they have 525 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They do report all their financials in Canadian dollars. I converted to US dollars since we're looking at the ticker that trades in the US. In a little bit, we'll look at their income statement, which is in Canadian dollars. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow doesn't look so great, negative 1.1 billion. It is improving, it's down to negative 425 million. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also negative each year. The biggest negative in 2023, negative 2.5 billion. Revenue is the sales for the company, and that doesn't really move too much. It did jump up a lot from 2020 to 2021, but came right back down to 2020 levels. 2023 is almost exactly what it was in 2020. Here's the company's income statement. Their fiscal year ends 3/31, so they did complete their 2023 fiscal year, which started on April 1st, 2022, ended 3/31/2023. So revenue for 2023 was 450 million, down from 2022 of 570 million, and even lower from 2021 of 600 million. So they're not moving in the right direction. Cannabis companies and also tobacco companies have to pay a lot in excise taxes. They paid 48 million, so their net revenue is 403 million. Let's get a breakdown of the 403 million so we know what it is. Of the 403 million, 95 million is business to business adult use cannabis. 36 million is business to consumer adult use cannabis. So total adult use cannabis 131 million, down from 200 million last year. Medical cannabis 56 million, so we're up to 187 million. They divested C3, the cannabinoid compound company. So that's why they have no revenue in 2023. Last year was 36 million, before that 62 million. All sales outside of Canada are 39 million. The 187 million is just Canada. Then there's Storz & Bickel. This is a leading vape company, 65 million, also down from last year. BioSteel, they sell energy drinks, 69 million. That is up a lot from last year, more than double last year's number. The skincare brand This Works, 26 million, down from 32 million. And then other revenue of 16 million. That makes up their 400 million of net revenue. Here's a breakdown of their revenue by country. 268 million in Canada, 49 million in Germany, US only 39 million. If cannabis becomes legal in the US on a federal level, then their sales will go through the roof. But it's still illegal on a federal level, legal in certain states though. And then other countries, 47 million. Let's go back to the income statement. So their cost of goods sold are 500 million. That gives them a negative gross profit, since cost of goods sold is higher than net revenue. Same thing last year, negative gross profit. In 2021 it was positive. They do have operating expenses, 450 million of SG&A. They probably spent a lot of money in marketing. 31 million of stock-based compensation. They had a huge asset impairment, 2.3 billion. These are goodwill impairments, writing down the value of a company they purchased in the past. So total operating expenses 2.7 billion, an operating loss of 2.8 billion. A loss of 466 million in other, so their net loss is 3.3 billion. You could probably ignore the $2.3 billion asset impairment, so it's really a net loss of 1 billion, which is still pretty high. And they add shares each year. They had 370 million in 2021, 390 million in 2022, and now 460 million currently. Let's look at their capital structure. 1.1 billion of equity, 900 million of debt. They're 54% equity, 46% debt. Their net debt is $300 million, so they have about $600 million of cash on their balance sheet. They have a pretty high WACC, 16%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $1.2 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $463 million. We divide that by 525 million shares. And we get a calculated stock price of 88 cents. They're trading at 60 cents, so they're trading at a 32% discount. It's a buy according to the model. All 3 cannabis companies we're looking at today only generate negative free cash flow. I can't forecast they would have negative free cash flow forever because that means the stock price would be negative, which is impossible. So I have to assume they would generate positive free cash flow at some point. Based off of CGC's revenue targets, I came up with $160 million of free cash flow in 2027. Now, if they can hit this number, the stock does seem undervalued. I personally would not invest in this company because I don't think they'll hit this number. I don't think they'll ever get positive free cash flow, but that's just my opinion. Let's look at the stock on Simply Wall Street. They're trading at 60 cents a share, 323 million market cap, down 5% in the past week, down 84% in the past year. It looks like they started trading in 2014. The stock peaked at close to $60 in 2018. It fell to $10 during COVID, then jumped up to $40 by February 2021. But ever since then, it's only gone downhill. 14 analysts priced this stock and the average price target is $254. They say the stock is 320% undervalued. In the past year, there's been only insider selling, no buying. All the sells happened on the same day in December by 3 different people, a few thousand shares each. 58% of the company is held by the general public, 32% by public companies, and 10% by institutions. Their biggest shareholder is Constellation Brands at 32%. They only had 20 employees in 2013. It peaked at 4,900 in 2019. It's currently at 3,200. The ticker trades on the TSX, NASDAQ, and Deutsche Börse. The second company we're going to look at is Cronos Group. This is a small cap company, 720 million market cap. They're trading at $190 a share, and they have 381 million shares outstanding. Let's look at their financials. They report all their numbers in US dollars, so there's no conversion necessary. Same thing with CGC, negative free cash flow each year and negative net income each year. Revenue doubled from 2020 to 2022. It came down a little in the trailing 12 months to 87 million. A lot lower revenue than Canopy. Here's their latest report, the first quarter of 2023. Revenue of 20 million, down from 25 million. Let's see what feeds into the $20 million revenue number. Here's a breakdown of the 20 million of revenue. 13 million cannabis flower and 7 million in cannabis extracts. Of the 20 million, 14 million is in Canada, 5 million in Israel, 649,000 US. Their revenue went down a ton in the US, it went down a good amount in Israel, it went up slightly in Canada. Let's go back to their income statement. In order to generate the 20 million of revenue, it cost them 18 million. So they do have positive gross profit of 2.4 million, which is down from last year of 7 million. Sales and marketing, 6 million, R&D, 2 million, general and administrative costs, that includes payroll, 12 million, stock-based compensation, 2.6 million, depreciation and amortization, 1.5 million. So total expenses, 24 million. That gives them an operating loss of 22 million. So their net loss after taxes and everything is 19 million, compared to a loss of last year of 33 million, which is a loss per share of 5 cents. Last year was a loss per share of 9 cents. This is just for the first quarter of 2023 compared to the first quarter of 2022. They did add 5.5 million shares. Last year they had 375 million. Now they have 380.6 million. The way you calculate earnings per share, it's net loss over shares outstanding. That's how you get to 5 cents. Let's look at their capital structure. 1.1 billion of equity, only 4 million of debt. So they're 100% equity. Plus they have over 800 million of cash on their balance sheet. I gave them a WACC of 11%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 338 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $161 million. We divide that by 381 million shares. And we get a calculated stock price of 42 cents. They're trading at 190, so they're trading at a 350% premium. It's a sell according to the model. Let's look at the ticker on Simply Wall Street. It last traded at 190 a share, 700 million market cap, down 39% in the past year. It looks like the stock started trading in 2016. Its highest point ever was in 2019 at $23. It did have a little bump at the end of 2020, and it got up to about $13 a share by February 2021. Then it's only downhill since then. Simply Wall Street's valuation is $1.24. They say the stock is 53% overvalued. 9 analysts priced this stock and the average price target is $258. They say the stock is 36% undervalued. The CEO makes almost $700,000, total compensation $18 million. That's a pretty nice payday for a company that's losing so much money. In the past 12 months, there's been only insider buying, no selling. It is hard to tell on this list, but it's all by Gotham Green Partners. This chart is a little easy to read. 500,000 shares purchased in the past 0 to 3 months, 1.3 million shares purchased in the past 6 to 9 months. 42% of the companies held by the general public, 41% by public companies, 11% by institutions, and 5% by insiders. Marlboro Cigarette, Altria is the biggest company, 41% they own. They only had 4 employees in 2013. It peaked at 631 in 2019. It's currently 447. The stock trades on the TSX, NASDAQ, and Deutsche Börse. The third and last stock we're going to look at is Sundial, SNDL. This is a small cap company, 359 million market cap. They're trading at 138 a share, and they have 260 million shares outstanding. Like the other 2 companies, negative free cash flow every year, negative net income each year. But their revenue is a lot bigger. It went from 46 million to almost 700 million in the trailing 12 months. I had to convert their numbers from Canadian dollars to US dollars, since we're looking at the ticker that trades in the United States. Here's their latest income statement, the first quarter of 2023 compared to the first quarter of 2022. Net revenue of 202 million, up a lot from 18 million. They're doing lots of acquisitions. Let's get a breakdown of the 202 million. Liquor sales 115 million, cannabis 67 million, and cannabis operations 19 million. This 19 million is a revenue from Valens. Valens is a cannabis manufacturer. In order to generate the 200 million of revenue, it cost them 158 million. They took an inventory impairment of 9 million. So their gross profit is 35 million, up from 1.3 million. Then there's some other adjustments. So total gross profit, 32.5 million. They had 49 million of general and administrative expenses. This is the payroll for the CEO, the CFO, other employees. Sales and marketing, 3.3 million. Depreciation and amortization, 16 million. So they did have a loss from operations of 32 million, which is worse than last year of 23 million. So their total net loss is 36 million, not as bad as last year of 38 million. Loss per share in the first quarter is 14 cents. Last year was a loss of 18 cents. This slide shows us the calculation for EPS, so it shows us the shares outstanding. Last year they had 206 million. They added 50 million. Now they have almost 256 million shares outstanding. Let's look at the capital structure. 1 billion of equity, 130 million of debt. They're 89% equity, 11% debt. They could pay off all the debt with the cash on their balance sheet and still have 58 million of cash left over. I gave them a WACC of 12%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 2.4 billion. We discounted those numbers back to today using weighted average cost of capital. We get a value of the company of $1.6 billion. We divide that by 260 million shares. And we get a calculated stock price of $6.25. They're trading at $138, so they're trading at a 78% discount. It's a really strong buy according to the model. This is assuming they do hit that revenue target by 2026, which is a big assumption since they only had negative free cash flow historically. There are 100 companies in the same industry as Cronos, Sundial, and Canopy. Most companies in this industry don't deal with cannabis, so it is hard to compare. Cronos ranks 29th in market cap at 720 million, Sundial 39th at 359 million, and CGC 45th at 315 million. All of them have really good price to book ratios. but we can't look at any of their PEs or price to free cash flows since the numbers are negative. Cronos doesn't have a good price to sales ratio because they only generate $87 million of revenue compared to a $723 million market cap. But Sundial and CGC have really good price sales ratios. Look at Cronos' 5-year annual revenue growth rate, 77%. It is easy to grow at big leaps when you have such small revenue. When your revenue is higher, it's a lot more difficult to grow at 10, 20, 30% each year. Let's look at SNDL on Simply Wall Street. Last traded at 138, 356 million market cap, down 65% in the past year. It looks like it was trading over $100 in 2019. They must have did a reverse stock split. So it's down about 98% since that point. Not doing that well. So it's right here. In July of last year, SNDL announced a 1-for-10 reverse split. If you put $10,000 into this company when they started trading in 2019, you'd have 132 today. Almost a 99% loss. There are 2 analysts pricing this stock and the average price target is 326. They say the stock is 137% undervalued. Simply Wall Street does not value the stock, so we can't look at that. There's been no insider buying, just one sell in the past year. That was almost a year ago, 33,000 shares. 93% of the company is held by the general public and only 6.5% by institutions. Their biggest shareholder is ETF Managers Group. They own 2.77% of the company. They had 386 employees in 2018. It's at its highest point ever, 2,600 in 2022. And they do not trade on the TSX. They trade on the NASDAQ and Deutsche Börse. So let me know what you think of the video. Leave a like, subscribe, or comment below. If you want to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.